Joanne, walk me through the data. What's the incidence analysis?
Ultimately, this month, consumers aren't really seeing a whole lot of material differences in the economic outlook relative to last month. And we see that in the fact that sentiment is essentially unchanged after 2 months of dramatic improvements. That being said, consumers do have a positive outlook on inflation. Both the short-term and the long-term expectations numbers came down a little bit. And so I do think that consumers are not expecting inflation to pop up again. They are expecting it to continue to slow down. In terms of the 5 to 10 year, it's been between 2.9 and 3.1 for the past 2 years. So while it's great news that it didn't go up, it's essentially unchanged.
Joanne, is this indicative, though, of the trend we're going to see, or is this a fluke in the numbers? Simply because when you look at some of the other economic data we're getting, I'm going to push it back to the CPI, PPI numbers that Guy and I were just talking about. You are seeing this divergence. And I'm wondering, and even if we are getting this consumer data, are consumers really feeling it? Your thoughts?
So they're definitely feeling that inflation is slowing down. And we see that in a number of places in the survey, not just been in the expectations, but when we ask people about buying conditions for cars, for durable goods and for homes, they've noticed that inflation is slowing down. That being said, high prices are continuing to weigh on consumers' minds. We still have about 37% of consumers telling us that high prices are eroding their living standards. So it's still hurting them in the pocketbook.
In terms of the relationship to gasoline prices, where were we when the data were taken, and what do you expect to happen from here as gas prices continue to push higher?
The data that we released today are based on interviews throughout the last 2 weeks. So some, and there's of course some geographic variation in how gas prices are going. So gas prices are going to influence people's sentiment, but I would not say that's the only thing that's going to be pushing the inflation expectations numbers, because consumers really are thinking about prices in general.
Joanne, one of my favorite charts, I have to say, on the Bloomberg terminal is when you look at kind of consumer data or the UMich consumer sentiment data and then look at card spend. And ordinarily, they kind of track each other very closely. To your point, if people are feeling good about the economy, they're going to be spending more. You have seen a divergence in that kind of data, though. Can you explain or perhaps even theorize why that might be?
Absolutely. So consumers have been feeling really dismal about the economy since inflation started, and that's really weighed on consumers' minds. But spending continues to be robust because of labor markets. Consumers continue to feel that their income prospects are strong, and that's precisely what is supporting spending.
So where does that leave us? The two big threats that the financial markets, Joanne, are trying to figure out right now are, do we get a recession? If so, what kind of a recession? And what's this kind of the medium-term trajectory for inflation? If you think about those two risks, what are your data telling us about where we are?
What the data tell us is that consumers continue to be concerned about high prices. They are expecting inflation to slow down. But I think the big question for investors, for consumers, and for policymakers is what's going to happen with labor markets. Is this soft landing going to be achieved? If labor markets continue on the trajectory that they are, I think that's going to be great news for consumers. It will continue to support spending. But consumers are still sort of sleeping with one eye open and waiting for the other shoe to drop. And if labor markets start to weaken, then all bets are off.
Joanne, I'm so glad you mentioned perhaps sleeping with one eye open, because I think one of the things that is probably lost in this narrative is that if, for the folks who are still believing that a recession is on the table, it doesn't necessarily happen gradually. It happens all at once. And those kind of wave of layoffs can happen all at once. In your expertise in this particular survey, in that sentiment, how quickly can the data change?
The data typically are not going to plunge or spike for no reason. And when there are layoffs, when there are slowdowns in the labor market, even if there are well-publicized layoffs in one particular sector, particularly like, for example, the tech sector in the last few months, that's not necessarily going to move markets. But over the course of several months, if there are mass layoffs in a number of different industries, that will absolutely move sentiment dramatically.
On that note, labor power, unionization is not as strong as it once was, Joanne, in the United States, but we're starting to see some fairly punchy deals being delivered by the Teamsters and various other unions. To what extent, I'm curious how you think that might fold into what you are going to see. It's not a heavily unionized labor force in the United States in the way that it once was, but we're seeing some fairly eye-popping numbers. Do you think those kinds of numbers from UPS into the auto sector, again, does that give the consumer extra confidence, the kind of confidence you've been talking about, to continue spending in the way that they are, that will ripple out into the rest of the wider economy?
So I think it's unlikely that it will ripple out to the wider economy, because when consumers think about labor markets and think about incomes, they're typically thinking about how it affects them. So unless they are specifically in a unionized industry or belong to a union, it may not affect their own income expectations. And on the contrary, strong labor markets are seen by consumers as something that's not actually good for businesses. You know, if businesses are having trouble hiring people, it can still be seen as something that's a vulnerability for business conditions. So it will cut both ways. If it affects their own incomes, it'll support spending. If it's something that really jeopardizes businesses' ability to hire and retain workers, then it won't be a good thing.